Hello and welcome back. It's time to take another look at private capital. A lot has happened in the last couple of months, so I thought we'll start off by taking a big picture look with an investor perspective. So, a little bit of data first for perspective. Private capital, what I mean by that is not just venture growth buyout, but real estate, infrastructure, private debt, natural resources, all included, has had an incredible growth in the last 20 years. So if you look at this, I refer to it as the Moore's law of private capital, maybe not quite every 2 years doubling, but every 4 to 5 years doubling in terms of assets under management in this respective asset class. Now, who allocates the most to private equity? There, basically, we've seen a little bit of change, but still, family offices, the entities of high net worth individuals and families that may have sold some of their family business, allocating to private equity, are still by percentage of total AUM ahead of the curve, with around 20% of their AUM allocated. Again, this is a global number. When we go around the world, it's quite different, and allocations, if anything, increase as we go from west to east. Dry powder, the term that the press likes to bat around, dry powder has naturally increased as well. Let's not forget, the private equity model relies on private equity firms having money readily available if and when opportunities present themselves. So by definition, the industry will never run out of dry powder. Nevertheless, the measure to keep an eye on is dry powder within 20 to 35% of total AUM. Should it ever fall below 20%, I would start getting worried. And should it ever go above, let's call it 40%, I would start getting concerned about the ability of private capital to find investable companies to invest in. Until then, though, yes, assets under management have increased, so has dry powder. Now, obviously, with AUM going up, and seriously large numbers of private equity firms looking for a target, clearly prices have increased as well. If you look at 2008, we were at about 7-8 times EBITDA multiple per as a valuation of firms that are acquired by buyout firms. And but nowadays the number is closer to 11.5 to 12 times EBITDA. As you can nevertheless see, as we're standing here in the first quarter of 2023, we are seeing already valuations drop in line with the behavior of public markets. So private equity, whilst delayed in adjusting to market environments that are potentially a bit more contentious than what we've seen in the last decade, private equity is also exposed to gravity, and in line with its public market peers, will start seeing lower valuations. Now, there are pros and cons on that. As a private equity fund, I am on the one hand hyper excited when I can achieve exits at a decent price, or potentially, as we saw in the last 3-4 years at times, at valuations that exceed even the upside modeling on entry. Nevertheless, as one exits, one obviously is also keeping an eye on entry valuations, and it's pretty much the other side of the same coin. Now, valuations obviously are significantly lower now. To enter into deals, competition is a little bit less as well, because private equity firms, despite well-funded, are rather sitting on the sideline and waiting to see what happens. We will have to see what happens in the second half of 2023. But also interest rates have increased substantially, so any one of the buyout funds working with debt and leverage will obviously have to adjust their model before they assess whether or not to go into in a private deal. On that note, that is basically brings me to the end of that very, very brief update from an investor's perspective on the latest in private equity and venture capital. We will come back and I will see you for our next session where we have a closer look at venture capital. Thank you.